Do the count there so that I'll be ready. Good morning. My name is Opoku-Agyemang. I welcome you to the BSB Investor Webinar Series. It's been an awesome 3-day program. The first day, we had the captains of the investment management industry. Yesterday was also another awesome experience where we had all the special deposits taking institutions regulated by BOG and their rural and community banks as well. It was also an awesome experience. Today is dedicated to the insurance community, and just in line with the grand theme for this particular webinar series, it is all about reliability in times of uncertainty, making investment decisions that will be resilient enough such that even if there's a pandemic or financial sector reform, whatever the challenges are, based on the kind of investment decisions we make, it will be able to withstand the test of time. For today, we are honored to have our guest of honor for the entire program, Mr. Ekow Afedzie, on board. He's going to give us an opening remark, and he will give us he also end the entire program for us. We also have fantastic speakers who will be sharing their thoughts with us, and we'll be tapping into their wisdom. We would have the opportunity to listen to a woman that I always refer to her as the female trailblazer for the Ghanaian capital market. And I'm talking about Miss Amoah, who is the Deputy MD for Ghana Stock Exchange. Aside Abena, there's also another stalwart for within the Ghanaian capital markets, a man that I draw a whole lot of inspiration from. I should declare that he's my first boss who gave me the opportunity to work in this industry over 13 years ago. And I'm talking about Mr. Tetteh. Mr. Tetteh is a financial consultant. He consults for the Ghana Stock Exchange. He consults for FSD Africa and a whole lot of other institutions. We will also get the chance to listen to another international partner of ours in the person of Mr. Imtiyaaz Domingo. Imtiyaaz is also a trader, an experienced trader with the Absa group. And Imtiyaaz will give us some perspective about the opportunities on the fixed income market for insurance companies. So it's going to be an awesome session today. And to kick it off, I would crave your indulgence for me to introduce Mr. Ekow Afedzie, the MD of the Ghana Stock Exchange, to give us his opening remarks for today. Then we will take it over from there. So, Mr. Afedzie, if you can hear me, sir, can we hear from you?
Good morning, To everyone, can you hear me? Agyei and the participants?
Yes, sir, we can hear you.
Okay. Let me first of all thank Agyei and your team, that's the Blackstar Brokerage firm, for inviting me to be the guest of honor. And also, I had the opportunity to make some remarks during your opening ceremony for the entire series of webinars you're organizing, and also have another chance to speak today. Let me first of all say welcome to the various distinguished panelists and participants, and especially to my colleagues and friends who will also be speaking today in the name of Mr. Abena and also David Tetteh. I want to start, first of all, by commending Blackstar Brokerage for this initiative of putting together these webinars. And I would like to encourage other stakeholders in the industry, especially brokerage firms, also to support this kind of initiative, and also to organize some of these investor education initiatives in order to contribute to the development of this capital market. As you said, days 1 and 2 have been very successful, and we are having day 3 today, which will concentrate on insurance companies and other pension funds or so. I'd like to say that it's important as a country that as we seek to develop, coming from the place where I work and the industry in which I belong, it's important that we focus our attention on 2 key things. One is to make sure that we can develop the investment culture in Ghana. We need to develop the investment culture, because without the investment culture being developed, it's going to be difficult for this country to have its economy to grow. If we take a look at all the developed countries in the world, the savings rates are very high as compared to countries like Ghana and other developing nations. So we need to focus on that. How do we get our people to save and invest? Very, very key, as well as our institutional investors, such as insurance companies, where sometimes they get access to very long-term capital, especially through their life insurance. The other day I heard through another webinar organized by African Stock Exchanges Association, or African Securities Exchanges Association, where one of the panelists from Egypt was also making the same kind of comments, where he was trying to encourage insurance companies and pension funds to be able to participate in the capital market, especially the equity market space, where you have the opportunity, or companies have the opportunity to raise long-term capital. So that is one, the investment culture. The second one is the fact that we need to make sure that we can encourage our business people, our entrepreneurs, to utilize the capital market to raise long-term capital. Without that, it's going to be difficult for them to grow, expand, and employ the many people who are coming out of schools and getting unemployed. So these are 2 key things that we need to focus on as we develop as a nation, apart from all the other things that we need to do. Grow the investment culture, facilitate the mobilization of long-term capital in order to have our medium-sized companies grow, in order to have even the existing medium or large ones also be able to expand and grow. So to me, this webinar is very, very important. It's coming at the right time, and we should continue doing it. I will urge all the other stakeholders to get involved. The stock exchange has on its own this year, we have on our own this year, we're engaging many companies, trying to encourage them to utilize the facilities or the services being provided by the stock exchange in order for them to raise capital, either through issuance of equities or shares, or using the bond market to raise corporate bonds. So it's important that together we all do this. As an exchange, throughout our 30 years, we've been able to raise about 15 billion cedis through the issuance of shares and also corporate bonds. Although we set up a bond market, a formal bond market 6 years ago, we've seen about 10 corporate bodies issuing almost 11 billion cedis through this market, whilst it's taking the equity market 30 years to raise just 5.4 billion market. So we have a lot of opportunities on the market. Either you do equities, which is more of a patient capital, or you do bonds of certain maturities, medium to long-term maturities, where you can raise long-term capital. The market is beginning to bounce back. We're beginning to see some confidence back in the market. We've seen the index rising up to about 39.7% as we speak. And we don't expect it to, we expect it to continue showing positive signs or returns as we move towards closer to the end of the year. So unlike institutional investors, insurance companies, and others to start looking at this market again. David Tetteh will prove to you that over the years, the market has generally been good to investors, provided average returns of about 25%, although we've had some bad times, but we've had very good times during the year. So I'd like to end by saying that it's important that as a nation, we begin to look at these things carefully. As an nation going forward, there are about three key things that we are going to be doing. One is we will seek to broaden the investor base on the market as enshrined in the capital markets plan initiated by the Securities and Exchange Commission, and as also enshrined in our own strategic plan for the next 3 years. We will improve the infrastructure on our market, especially using technology in order to bring the exchange to the doorstep of investors, and also improving information dissemination. We will make sure that we enhance compliance in order to generate the needed confidence that we have in this market. These are some of the things that we want to be doing in order to be able to transform our market from a normal frontier market to an emerging market. We need to be able to do some of these things so that we can attract more investors to the market and attract more insurers to the market. On this note, I'd like to wish all the participants well, and also I wish that we have a very good webinar today. And I'll come back at the end of the program to also close it and also share my thoughts on what will be discussed today. So thank you very much, Agyei and your team, for this opportunity.
Much, Mr. Afedzie, and thank you for extending the invitation to our audience today, which is the insurance companies, on the fact that they can raise various forms of capital from the Ghana Stock Exchange and also from the fixed income market, and also for encouraging them to, especially the life insurance policy providers, that they can actually invest in equity securities in terms of matching their long-term liabilities with a more long-term focused assets like the equities. As well, they can also look at buying various fixed income securities that can suit insurance policies that have short-term maturity. So thank you very much, Mr. Ekow, Afedzie. I wouldn't take much time. We have three presenters today, and each of them are going to take 10 minutes today. Then we would open for questions and also set the tone for discussions. So without taking much of the time, I would invite Ms. Abena Amoah, who is the Deputy Chief Executive Officer of the Ghana Stock Exchange, who will be presenting on the Ghana secondary bond market, the opportunities in the future for insurance providers in a period where we've been hit by one important exercise, which is the financial sector reforms, and also the unfortunate emergence of the COVID-19 pandemic. So as we transition through these two events, Ms. Abena Amoah will take us through how we can all leverage on the Ghana fixed income market to meet various investment needs, and if possible, also raise capital from that. So I would hand over to Ms. Abena Amoah. Ms. Abena Amoah, if you can hear me, good morning.
Good morning. I hope you can all hear me and see my screen as well.
Sure, I can hear you, and yeah, I can see your screen. Yeah,
Thank you.
Please, can you take it to slide view mode, please? Your screen. Okay, thank you very much.
Good morning to all of you, to the distinguished panelists, especially all our partners in the insurance industry. And I join Ekow to congratulate Black Star Brokerage for putting together this very important series of discussion. Today I'm here to talk about the Ghana fixed income markets and the opportunities for the insurance sector, especially as we emerge from two big events that have happened over the last 3 years: a global pandemic and financial sector reforms, which have provided lessons for all of us. I will briefly introduce the Ghana fixed income market, why the Ghana Stock Exchange led the process to formalize our secondary trading in our fixed income securities. I'll share some statistics on the market with participants. I will discuss some opportunities on the market for the insurance sector and the future of GIFM. The fixed income market is really a secondary market for trading of all fixed income securities and others that the GSC will license. Almost 6 years ago, the GSC saw the need for formalizing the entire fixed income securities industry, especially those that were issued to the public. And so in partnership with stakeholders like the Bank of Ghana, the stockbrokers, the CSD, the Ghana Association of Bankers, the Ministry of Finance, and other partners, we agreed, and the SEC issued a line, accepted the establishment of the Ghana fixed income market under the GSC's license of securities trading. And so the Ghana fixed income market, which was set up in 2016, is under the GSC's license as a securities trading platform. The reason why we thought it was important to formalize this was to, one, bring about greater efficiency in the secondary bond market. It was important to put all the operators in the market together so that people could see, if you're an investor and you wanted to buy something that was already issued, you knew where to go, you knew the data on it in terms of pricing, you knew that there was a more efficient way where there was data to fuel your investment decisions. So the insurance sector participants will know that at any point in time, there are all these various operators out there, and I can reach out to them to sell or buy more of my fixed income securities. Better price discovery. We thought that it was important to facilitate through our platform disclosures of pricing, to have market makers in there that could quote prices to investors so that people's investment objectives could be achieved. Greater transparency, bringing all the parties together was critical so that, again, you knew the best price you could buy at, you could see what offers were on the market, you could see what other people wanted to bid for various products or various instruments. Liquidity, the main purpose of these secondary markets is to provide liquidity so that when an investor buys any instrument, for instance, you bought a 5-year bond and your liquidity needs have changed, or you have excess liquidity and you want to invest it, you know exactly where to go and how to see the prices on the market, who was holding what. So we thought that formalizing this fixed income market, which we now call the Ghana fixed income market, was critical to achieving these goals. The market has been has shown phenomenal growth since 2015. When we started in the first 4 months, we traded 5.2 billion volume of securities. We more than trebled that in 2016 to almost 17 billion volume. We doubled that in 2017. And for the first time in 2020, volume traded exceeded 100 billion. And so far, January to June this year, we have traded 107.6 billion. And indeed, as at yesterday, the market had traded year to date about 125 billion worth of volume of securities. We believe that we are on track to almost double what we did last year. There has been very strong growth in secondary trading of these securities. And I must say that the insurance sector and the pension sector have contributed significantly to this trade. The number of trades too, as you can see from my screen, has been growing tremendously. 2021, January to June, we have already done about 126 million transactions versus 81, almost 82 million transactions, 82,000, sorry, transactions compared to the same time last year. In terms of outstanding securities, government continues to dominate. Compared to 2020, we are currently at 144 million securities from government versus 100 million last year. The corporate sector, where we think there is potential for significant growth, this year we are at about 30 million in issuances, outstanding securities compared to 27 million last year. So this is an area for further opportunity and growth for us, because we believe that the corporate sector, as Ekow said at the beginning, is one of the key drivers of economic transformation and growth. And this is one of the areas we want to work with the insurance sector to unlock. In terms of liquidity, we are seeing improvements in the corporate bond performances. So liquidity has more than doubled from last year's 14% to about 34% so far this year. And the same thing has happened in the government instruments as well. Opportunities in the fixed income market for us are three main areas. We think raising capital, becoming issuers yourself of debt securities, investing, what you are doing already, doing more of that, buying debt securities, and then also product development and new initiatives. Corporates have raised up almost 11 billion on the market in the 6 years period since we formalized this market. You can see the main issuers on the market. Many of them have been financial institutions such as Itsway, Letsego, Bayport, Bond, etc. Daylex. We have a few government, we have a few non-financial institutions, Edendale, PBC, Quantum, and then of course the two SPVs that government set up, ESLA and Dache Trust PLC, who have become the biggest issuers on the market. 69 different instruments of fixed income securities have been issued so far to raise the 10.8 billion Ghana cedis during the 6-year period. But importantly, what we see the corporate issuers do is what we call the shelf registration. They determine their long-term needs and register so far about 17.6 billion Ghana cedis, of which they have issued and raised 10.8 billion Ghana cedis. So this is something insurance companies can do. If you determine your long-term needs as you look to invest in, for instance, the real estate sector, then you can come and do a shelf registration of your medium-term needs and then raise capital as you develop your projects. I will not focus too much on the listing requirements for issuances, as my colleague David will do that. We want to look at the asset allocation of insurance firms according to the NIC annual report of 2019. And where we can see here is the, sorry about that, is the breakdown of your investments, your asset allocation in various instruments. For Government of Ghana securities, you can see that for the life sector, about 29% of your investments are there, whilst the non-life has about 15.6% of your investments in the sector as at the end of 2019. The other significant investments we see is term deposits held at a bank, where the life sector has about 11% and the non-life sector has about 19%, and other term deposits as well. When we look at your investments in equity-backed mutual funds, we're almost at 0% for both types of businesses. Money market mutual funds, the life sector has about 2%, the non-life sector has about 0%, and then land and buildings held as investments, 28%. It's a significant holding for the life sector, and 26% for the non-life sector. When we look at corporate debt securities, life has 2.9%, non-life has 0%. We think that this is one area that especially the life sector can play a much more significant role in. And so this engagement, we hope at the end of the day, leads to the movement and the build-up of more investments in the corporate debt space. The yield curve over the period has been correcting. Government is rewarding investors in longer dated instruments. On the government side, we have up to 20-year instruments on the market, providing a benchmark for pricing for issuers along the yield curve. On the corporate side, the longest issuance we have so far is a 10-year corporate bond. Another area of collaboration for us is product development. For us at the stock market, we're looking at how we can bring more excitement, more relevance, more liquidity, more products to all stakeholders. So to this purpose, we established the repo market and introduced the Global Master Repurchase Agreement, where once the repo transaction is transacted under the GMRA, or the Global Master Repurchase Agreement, the ownership of the instrument that is the subject of the repo moves to the party that has entered the repo and allows them, they enter the agreement and allows them to trade in that instrument as well. So we think that is something that is critical to enhancing the liquidity on the market and the safety and confidence of insurance and investors in the sector. So this is one of the areas we also invite the insurance sector to participate in, entering into repo transactions with people that need them, such as banks, etc., under the Global Master Repurchase Agreement. We're working together with the Ministry of Finance to introduce a domestic credit rating agency. When we met with the insurance sector the last year under a seminar, one of the key things we discussed was rating of various instruments and various issuers, so that when it comes to your capital provisioning and etc., the better rated instruments get the haircut isn't the same, so it helps to guide your investment decisions. We're working with the Ministry of Finance to possibly launch the first domestic credit rating agency this year. The GIFIN market is looking to also launch a first set of indices. So it helps investors to monitor their performance and see how they are performing relative to other instruments on the market. Securities lending and borrowing is something we're working assiduously on. Following the introduction of the GIMRA, we believe that, again, we bring a global master agreements to our securities lending and borrowing. This will allow those that hold instruments to maturity to earn some income even as they hold instruments to maturity by lending and borrowing instruments to facilitate their investment decisions. And again, we think this product will enhance liquidity for savvy fund managers. New assets classes are critical to sustainable financing. We hear you talking about green bonds, infrastructure financing, social financing. We're working to introduce guidelines for the listing of such instruments on the market. REITs, the SEC has a framework for the issuance of REITs. There are all sorts of tax incentives for that. We again, as the insurance industry with significant portfolio of real estate investments, to look at issuing, listing, and trading REITs on the market. Exchange traded funds is another area that we're working to introduce more. We have one so far on the market, New Gold, and we're working to bring more ETFs onto the market. Digitalization of investment experience and the sharing of financial information to everyone, to fund managers who are sitting looking at their portfolio every day, pricing their portfolio, marking their portfolio to market. We believe that digitalization of the exchanges trading data and experience will facilitate your work towards that. So these are all areas we look to partner with insurance companies. Get yourself rated to facilitate your issuances as well. So thank you very much for the opportunity to present a little bit about the fixed income market, and I'll take any questions. Thank you.
Yeah, thank you very much, Ms. Abena Amoah, for your presentation. And for us at Blackstar, and having worked on the fixed income market and having come out as a significant player on the market, we are very, very aware that the fixed income market has a good potential, as you showed in your presentation. And also we know the volume of activities has been growing day in, day out, and which shows the level of liquidity and how easy various investors can get securities and can, do any form of investment on the market to meet various investment needs. And it's very refreshing to also hear from you today that there are various initiatives that are going to deepen the markets and also going to ensure that we have various products on the fixed income markets. And again, it's good to hear that there's a repo market, which I think I was also there when it was launched at some time last 2 years, which also gives liquidity to short-term liquidity to investors. And with our audience we have today, I believe they'll be excited to know that, especially those who are not in the live investment, life insurance policies, they can also go on the repo market and meet various short-term insurance policy needs. So thank you very much, Ms. Abena Amoah. And we have quite some number of questions lined up for you. So I would say don't leave us yet. Just hold on. We'll just move on to the next speaker for today. And the questions, we'll bring the questions after all the speakers are done. So then we can proceed with the discussions as the questions come in. So the next speaker for today, after Ms. Abena Amoah, is Mr. David Tetteh, who is a financial consultant. What he'll be looking at is raising capital for insurance companies in a period of transition from the pandemic and the financial sector reforms. And he's just going to, throw more light on the position, how to position your business to attract investors, which is very important. Then strategic funding alternatives, which I believe Mr. Ekow, Afedzie, and Ms. Abena they've been trying to entreat us to raise various forms of capital from our market. So Mr. David Tetteh will show or will speak more on the alternative source of funding that we can get from the capital markets. Then he will also throw more light on the transaction process, timing and closing. So I would hand over to Mr. David Tetteh. Mr. David Tetteh, good morning, if you can hear me.
Good morning to you, and thank you for the invitation. And good morning to our participants as well. Let me try and share my screen.
Is he speaking? Mr. David Tetteh, I understand you're speaking, but we can't hear you. Yeah, hello, Mr. Tetteh, can you hear me?
Hello, can you hear me?
Yeah, we can hear you now. I think, yeah, you were speaking, but we couldn't hear anything from you.
Okay, I'm trying to share my screen now so that we can.
Okay.
Yes, so going to talk to you about capital raising for insurance companies after the pandemic. Globally, we have had a slowdown when it comes to capital raising. If you look at both private markets and public markets, you see that the data shows that in 2020, there was a massive decline in equity capital raising. So the pandemic has affected all companies across board, not just companies in Ghana and not just insurance companies in Ghana.
I'm not sure. Have you shared your screen already, or?
Are you able to see my screen?
No, I'm not able to see your screen.
Okay, let me.
Yeah, I think it's loading now. Great. So if you can take it to slideshow mode for us, please. Great.
Okay, so I was just telling you that globally, there has been a slowdown in capital raising. If you look at the statistics I'm sharing, it shows that both in North America, Europe, Asia, there has been a slowdown in capital raising across markets. In public issuances, there has been a slight increase. If you look at especially Europe and US, what happened is in Q1 and Q2, there was a slowdown in equity issuances. But in Q3 and Q4, especially after lockdown started easing, we saw a lot of companies going back to the market to try and raise capital. A lot of this was existing listed companies that did follow-ons. Of course, the pandemic had impacted companies' cash flow significantly. So a lot of listed companies went back to the market to do follow-ons for additional capital. Africa has also seen a decline. If you look at African private equity activity in the last 5 years, you can see a significant, continuous decline to 1.1 billion as at half year 2020 from a high of 4.5 billion in 2015. If you look at the public markets in Africa, again, the decline is obvious. Although in the last 3 years, even before the pandemic, there was a decline in equity capital market activity, and we didn't see too many IPOs or follow-on issues. The pandemic in 2020 saw more of a decline. So you see the graph is just 4.1 billion, very few, 0.6 billion in IPOs, 4.1 billion in follow-ons. So you look at the trend line and there's been a decline. So this shows clearly that globally and in Africa, there has been a decline in equity raising activities. On the debt market, it has been no different. If you look at the sub-Saharan African markets, there's also been a decline in debt issuances, both sovereigns and corporates. And we saw the same, we've seen the same trend globally as well. I mean, if you're an insurance company and you've been raising money since last year, I'm sure you may have felt the pinch, but hope is not lost. There are still a lot of companies that are interested in investing in the insurance opportunity in Ghana. We all know that the insurance penetration has been quite low, so represents a very big market opportunity. We also know that the take-up of insurance is, life insurance is also quite low. There's a significant opportunity for companies to gain market share. More recently, we've seen a lot of activity when it comes to capital raising. We saw a lot of foreign insurance companies acquiring local insurance companies. Hollard, Prudential, Old Mutual have all made entries into the Ghanaian insurance market. Alliance has also joined. It tells us that the opportunity for insurance companies are quite high, and so investors are interested. For companies that are listed on the stock exchange, we've seen SIC coming to do an IPO recently. We saw Enterprise Insurance raising over 300 million in a rights issue. So they have also undertaken some capital raising activities. We've seen private equity investments ongoing, talking to Keolac and Ghana Union Assurance Life, all looking to make an investment. And some companies have also done internal recapitalizations. They have had, surplus, income surplus, and they've been able to move this to stated capital to meet regulators' requirements. So depending on where you stand, you know that there is still money looking for investments in insurance companies. Apart from the typical issues that investors will look out for, management of your business continuity, the products and services that you offer, and the opportunities it presents for you to tap market share, your history, your profitability, efficiency, and others. A lot more focus these days is on technology. So what is the plan for your insurance company to invest in technology? We've seen a lot of move in InsurTech by existing players, while some are also working with fintechs to ensure that they are tapping into, or they are using the rise of Momo and other technology services to gain market share. So as a company, if you want to position yourself to attract investments, this is something that you definitely should be looking at. And of course, the resilience of your business. How did you withstand the pandemic? How resilient were your premium collections? How strong were your company's customers when it came to the pandemic? So your cash flows and your balance sheet as a result of what happened would help position you to attract the capital that you are looking for going forward. In terms of the pool of investors available, there are local institutional investors. Pension funds represent the largest pool of local funds available. We also have life insurance companies themselves. We have banks and other institutions that look to invest in the insurance opportunity. You've got the age-old PE funds that are aggressively looking for opportunities locally. You've got debt funds that also have an allocation to Ghana, who are looking for opportunities in the insurance space. And locally, we've got collective investment schemes. Some are set up to invest in debt, and some are set up to invest in equity securities. They all have allocations to securities that insurance companies like yours may issue. Of course, you've got the foreign institutional investors that mainly invest through the public equity markets. If you look at the stock exchange now, it's split almost 50-50 between foreign, institutional, and then local investors. So that is also an opportunity that your insurance company can tap into. And of course, the high net worth individuals, some of whom have already invested in insurance companies locally. In terms of the options, if you are, late in the day, in looking for your capital, of course, there's opportunity for you to acquire or be acquired. In this case, you'll be looking out for suitors. And we know that the Insurance Commission has been encouraging consolidations in the market. So it's one of the ways in which you can raise your capital to find a potential suitor that fits within your strategy and start talking to them to see whether you can put your companies together. But this usually takes about 1 year because it takes time for you to align your boards, your directors, your business and everything. So if you haven't already started, you are probably a little late. IPOs and follow-ons are also one way for which you can raise your capital. If you are looking to list on the GAX or the stock exchange, given that you're a regulated entity and all your books are okay, you should be able to close this within the next 6 months. You've also got the private equity option. You've got active funds locally, Oasis, Uhuru, that are looking to deploy capital in insurance. IMP, Synergy are all looking for life insurance opportunities. So they are people that you can start talking to. And if your books are really good, due diligence and closing, minimum average should be about 6 months. So these are all options that are available to you. But let me talk a little bit more about the public equity option for insurance companies, because I believe this represents one of the best ways in which you can, raise your capital. If you look at the local pension funds and their allocations, their recommended allocations by the NPRA, when it comes to equities, they are allowed to put up to 15% investments in equity securities and 35% in corporate debt. If you look at what they have now, is just around 1.58%, maybe in recent numbers, just a little around 2%. So the buy side opportunity available for local pension funds is about 2.6 billion, which is available for insurance companies like yours to tap into. So you don't need to go too far away to look for capital to meet your NIC regulatory requirements. Right here locally, there's an opportunity for you to tap into this money to meet your capital requirements. And given where you are as a regulated company, you should be able to close a transaction like this in 6 months. To get onto the stock exchange, the requirements are for a regulated company, it should be very easy for you to meet. It's like a walk in the park. So you should be a public limited liability company. To get onto the main board, you need at least 1 million or the GAX 250,000. These are things you meet easily. The minimum public float requires that you sell at least 25% of your shares to the public. To get on the main board, you need to get 100 shareholders, on the GAX 20 shareholders. And these you should meet at the time of your listing. So whichever route you decide to raise your capital, after you raise it, you should get at least 100 if you are getting on the main board, or 20 if you are getting on the GAX. Your shares should be freely transferable. You should have shown some reasonable pre-tax profits before you get approved for listing. In terms of corporate governance too, because you are regulated, we expect that at least you meet the requirement of having a majority of non-executive directors and 25% independent directors. And your management should also be quite competent. There are different ways in which you can approach listing. You can do an IPO where you invite, like SIC did, where you invite the general public to own shares in your company, or you can do a private placement. In this case, where you've identified the pool of funds that are available, you can reach out to these pension fund managers, make a direct pitch to them to invest in your company. And at the end of the process, you can get listed. Or if you want to use another route, if you're not looking to raise capital immediately, you can get listed via an introduction and then later on do a seasoned equities offering to the public or to a private group of investors to invest in your company. So the public equity option now guarantees that you see a direct pool of capital that is available. And if you go through the process, you can tap into this capital. The MD of the stock exchange mentioned the returns that the stock exchange have delivered over the period. So I took advantage of that to add to my slide to help, address some of the misconceptions that people have about the stock exchange and some that insurance companies like yours may have in deciding whether they should list or not. So if you look at the 31 years of existence of the stock exchange, Yes, there have been negative years. There have been very, very positive years. Those negative years have generally corresponded with things that are happening either locally or in the wider global economy. For example, in 2009, the returns were negative because we were coming off a global financial crisis. More recently, we've had a power crisis and then a financial sector cleanup, which is the result of what we are discussing today. How do you raise capital after such a pandemic or such a a shock to the economy? Now you see this year, the stock exchange has turned around, has already delivered dollar returns of more than 30%. So even the stock exchange is showing that after a pandemic and after a financial sector cleanup, there is hope for the market. So as a company, you can take advantage of this opportunity that is starting to brew on the exchange. Over the last 31 years, averagely, the exchange has delivered 25% to all investors. It means that every 4 years, the stock exchange has doubled money. In the first decade, the average was 29. In the second, it was 35. In the third, because of all the crises we've had, power crisis, pandemic, financial sector cleanup, it's been a little lower, 12.74. But given that there's a turnaround that has started already, I'm sure we should be getting back to average levels very soon. So it's a good time for you as an insurance company, if you're raising capital, to consider using the public equity route. So I'll stop here, and when there are any other questions, I would answer. Thank you very much.
Thank you very much, Mr. Tetteh, and it's so exciting again to see from your presentation on the fact that the stock exchange returns mostly it's a very long-term view investment vehicle. So if any insurance company, especially the life one, who usually have a long-term view, can't always rely on the stock exchange investments as a vehicle for them to put in the premiums, where to invest their premiums. Because, and I'm happy you showed a slide that really sort of throw light against the misconception that the stock exchange always returns negative. But when you look at it from the slide that you presented, it's clear that over the long-term period, it shows positive return, and this year is a very good example. We are still noting the questions, and Mr. David don't leave us yet. We will come back with the questions. We have another speaker here, and he is one of our partners who is out of our shores. The reason why we brought him in is for him to really throw more light on what other insurance companies out of our shores are doing with their investment in fixed income and other assets on capital markets. And he is going to give a presentation on fixed income securities as a strategic investment for resilient growth in transition era like what we are facing with the COVID-19. And he's in the person of Mr. Domingo. So Mr. Domingo, can you hear me?
Hi, yes, I can. Can you hear me?
Yeah, I can hear you. So I'll hand over to you.
Perfect. Are you able to see my screen?
Yeah, I'm able to see your screen.
Okay, perfect. Thanks, Blackstar, for organizing, and everyone for dialing in today.
Okay, so your voice is sounds a bit far away. So if you can get a bit closer to your microphone.
Is that a bit better?
Yeah, it's better now. It's better now.
Okay, perfect. Just to give a bit of an overview of the kind of the fixed income market as we see it in Ghana at the moment, as well as what some of the insurers have been doing in South Africa, as well as globally. I think as the effects of the coronavirus came through, the world went through kind of a number of lockdowns that led to reduced economic activity. That forced governments into increasing the government spending, as well as some tax relief. I think while that all looks pretty simple in there, they did have far-reaching implications for governments as well as consumers and companies alike. The slowdown in economic activity affected government revenues through kind of income taxes, value-added taxes, as well as other duties. Exports slowed, so the receipts from there was pretty slow. Government also had to increase spending to alleviate some of these pressures from the local economy, from the consumers, small to medium business enterprises, as well as just normal retail investors. Some of the relief that came through for individuals was obviously tax relief, as well as some relief for businesses, where they were granted tax holidays to alleviate some of the cash flow pressure that they've been under. That's just kind of a broad overview of what happened generically across the continent, as well as in South Africa. I mean, where does that will leave us in the fixed income space? The expansionary fiscal and monetary policy side of things has left overall our bond curve pretty a lot steeper. Ms. Amoah mentioned it in her presentation as well, where governments are being forced to reward investors buying in the longer end of the curve. And I mean, that's been consistent across the continent, from the more developed markets like Egypt and South Africa, to the lesser developed fixed income markets like Uganda, Zambia, Mozambique, Tanzania as well. Why this has happened, the looser monetary policy in order to stimulate the economy meant rates went lower and there was more cash in the system. So that meant there was an overwhelming demand for bonds from local institutions, from the insurance sector, pension funds, banks, asset managers, etc., all looking for a home for some of their cedi. But on the other hand, you've got to counteract that with the fiscal expansion that requires the government to fund a lot more than they were prior to COVID. This meant that government was increasing their bond issuances, extending some duration there, trying to get their hands on some dollar debt, trying to raise any cash they could. This increased supply in the bond curve kind of pushed the longer end of the curve higher. So we're starting to see that steepness come through. On the insurer side, what we've typically seen is bond yields across the continent, particularly in Ghana, still remain quite attractive. Real yields in Ghana are extremely healthy. You've got inflation just below 8%, and even your kind of front-end bonds are still trading at around 16.5%, 17%. So there's still a healthy enough real yield there for insurers to look at and get them interested. The bond market's still pretty liquid. I think if you look across the corporate spectrum, etc., and some of the other instruments you've got, the fixed income market has grown in its liquidity over the years. As the government issues more debt, they lengthen their maturity as well. We're also starting to see a lot more offshore investors get involved in Ghana over the last year or so. So that has increased the market liquidity in the fixed income space. So we have seen insurers across the continent actually take advantage of this and get more involved in the fixed income side of things. They're also looking to extend duration, and I probably want to spend a bit of time on this point. And a lot of the insurers in the markets are seen as almost the backstop or the real money buyers of the bond. It's purely just because it's an avenue where you can better match your asset and liability maturity profile. And because of the steepness of the curve over the last year or so, there is a big pickup in carry for any investors looking at the longer end of the curve. I've just put their rough numbers there, but you've got the 2039 in the Ghana fixed income space trading around 20%. Your 22s or 23s trading closer to 17%. So there's a 300 pickup there that you can pick up in bonds. just by extending your duration. Also worth mentioning that investors typically trade around this across the continent, particularly in South Africa, where they're a bit more kind of active. They shorten and lengthen their duration as they see things changing. And any kind of uptick in yields, we typically expect insurers, pension funds, etc., to come in and put their money to work here and pick up that extra carry. It also does provide, if you're looking from a kind of a Ghana economy point of view, it does provide some cushion if foreign investors or others exit the bond market, that the government will be comfortable that there are some local well-developed institutions who will get involved in the longer end of the curve. And again, this is typically where the government likes to raise their cash in the longer end, because then they can use that cash for obviously your longer term infrastructure projects, etc. Your shorter dated T-bill curve, etc. That's typically just used for liquidity management. But the longer projects that add more value to the economy as a whole and to the country as a whole is typically in the longer end of the curve. So that's where I think offshore investors as well look towards a well-developed local institutional market that gets involved there and supports the country in getting some of those projects on the go. And then just again, I was asked to bring in some of the South African experience. I mean, the South African experience or landscape was no different. The SARB, the Reserve Bank cut rates 300 basis points over the course of last year. They also introduced liquidity into the system. They were buying bonds from banks and other investors just to ensure that they had enough liquidity, that there was no kind of liquidity tightness or cash shortfalls in the system, just to alleviate the pressure. They also increased the weekly bond issuances, which had placed some pressure on the curve. I've just put a graph there that I put together from Bloomberg. The yellow line is Feb 2020, before the pandemic hit South Africa, and you can see the curve was pretty flat. You've got your long end bonds trading pretty tightly to your front end bonds, transitioning through to May 2020 already, post our lockdowns. You can see the curve steepened up quite significantly. The SARB cutting rates kind of placed an anchor on the front end bonds, so those pulled quite sharply lower, and the back end bonds weakened quite significantly, even though the SARB had cut rates by 300 basis points. So you can see the curve steepening there, and insurers obviously look to take advantage of this. In the South African situation, you've got the curve probably a little steeper than you see in Ghana. The 2023s or the 2048s rather traded at a 550 bp or 5.5% discount to where the shorter end kind of 2023 bonds trade. And insurers pretty much justify extending the duration as it matches their liability profile a lot better. And the 5.5% is not something to kind of they would shy away from. So they've provided some support there in the back end to keep the curve from kind of steepening even further. What we also see, and probably this talks into what Mr. Afedzie mentioned at the beginning, in terms of growing the financial product offering in the local market and letting it become a bit more sophisticated. In the South African market, we also see insurers trade in some derivatives. They look at interest rate swap markets, etc. But over the course of the pandemic, your interest rate derivatives have obviously been linked to the SARB cutting rate. So that's moved lower and bonds have moved higher. So they've taken advantage of that, and there's been a market shift away from derivatives towards more the cash products in terms of bonds, just because they offer so much more value. In the past, they would do some derivatives just because it's less cash intensive and it doesn't take away from some of their liquidity requirements. But at the moment, over the last year or so, we have seen a larger shift away from derivatives more towards the bond curve, just because it offers that much more value. Also on the growth side of things in markets that's also still developing in South Africa, we've also seen an uptick in corporate issuances, and insurers are starting to look at those for an uptick over and above where the government bond curves are trading. The more insurers that are getting involved in there, we are starting to see liquidity pick up, and it almost becomes self-fulfilling where everybody gets involved in the issuance. There is more secondary market liquidity, and it gets everybody comfortable around whether these are priced accurately, and it helps with the price discovery. But also, if it does come time to liquidate, there are other buyers in the market who would pick up these securities. And I think one thing that's probably limited across the continent, we see it in Mauritius, in Botswana, in Namibia a bit, but it is traded quite actively by particularly the life insurers in South Africa, is inflation-linked bonds. So how that works is at each reset of the bond, your bond notional upscales by however much inflation moves. So it typically trades in a real yield, so above where the nominals are trading, just so you can capture the real yield relative to inflation. Insurers typically like those because it typically protects them against inflation over a long time horizon, which is pretty much the core function. And then they've also got the kind of the duration in the curve to give them some extra carry to add to their returns, just so that they ensure so that they match up with their liabilities on that side. So I just thought I'd bring in those two on the back end, the corporate issuances and the inflation-linked bonds, just from a market development perspective in terms of what other products insurers and the like are looking at in the South African landscape. And then, yeah, I'll pause there.
All right. Thank you very much, Mr. Domingo, and thank you for sharing the perspective from the South African markets and what the pandemic has meant to the markets and what investors are doing up there. So I have a very quick question for you, and this is coming from one of our audience. So what he wants to know is, after the pandemic, have you seen a great shift or a paradigm shift in terms of asset allocation between equities and fixed income securities when you deal with insurance companies as your clients? Have you seen if they've moved around from either equity to fixed income or fixed income to equity?
Yeah, sure. Good question. Over the last year or so, I think there was a massive shift away from equities into fixed income. I think that's for a number of factors. Fixed income is obviously into sovereign fixed income. So obviously backed by governments, etc. All governments were also cutting rates, so that was a natural for yields to head lower. So I think over the last year, we've probably seen a shift towards away from equities, more towards fixed income. Going forward, though, over the last couple of months, we are starting to see investors shift back into equities, looking towards. I mean, if you look at the US, where there's growth coming through, you're also looking at yield curves across markets, starting with the US. The ECB also mentioned it, where they're stopping their bond buying programs, etc. You're also looking at yield curves tending to move higher. Guys are now shifting away from the fixed income, looking more towards the equity side, where they see the bigger growth. They're also looking to shift away from the fixed income side because of an expectation that interest rates will increase over the short term at least.
Thank you very much, Mr. Domingo, once more. There's a quick question here for Mr. Abena, Ms. Abena, forgive me. As you mentioned about the repo markets, and it was launched, I think, about 2 years ago, an audience wants to know how liquid is the repo markets, and he also wants to know about the volatility.
Thank you very much. We see a little bit more continuing transactions in the standard repo transactions. And so the banks are still entering repo agreements under the standard form. We're working with them to bottleneck a few issues around using the global master agreements that we've adopted for Ghana. But we think that once the product is there, people are beginning to take advantage of it. In terms of liquidity, we publish daily statistics on how we're doing on the repo transactions. So that is there as well for everyone to see. But it's a growing sector for us. It's a growing product. And I think as we continue to educate more people, people will take advantage of these liquidity provisions. Thank you.
Thank you very much, Ms. Abena. And I think in terms of the volatility of that market, and I was present at the launch, and I also participate on that market as well. And what I've seen from few engagements I've had with clients and what has played out on the market is a lot more of the interplay between demand and supply, and also how available is liquidity, and those two factors I see to be playing in determining what the extent of volatility, I should say. So in instances where there's a lot more demand, not a lot of liquidity on the market, you would possibly see the overnight rate on repos going up. You would like more than what you would ordinarily see on the market. In terms where there are a lot more liquidity from the banks and other players, then you can see the rate going down. So I think it's an interesting platform where the forces of demand and supply really set the tone of cost of overnight lending or borrowing. So just to the question, the volatility is largely determined by the markets. Now, we would have a very quick presentation from Mr. Eric Appiah, who is a managing partner of the Blackstar Group, and he will throw a bit more light on how the insurance companies can take advantage of the liquidity of the capital market in improving their revenue and also in soaring up their capital requirements. So I would bring Mr. Appiah in, and I have a couple of questions for Mr. Tetteh. So right after Mr. Appiah, I'll throw the questions to Mr. Tetteh. Mr. Appiah, good morning. Can you hear me?
Yes, hi, Emmanuel. I can. I hope you can hear me. Can you?
Yes, I can hear you.
Sure. I happened to fix my camera today, so.
Right.
I'm going to go into screen mode. So thank you very much, everyone. Ms. Afedzie, Ms. Amoah, Dominguez, and Mr. Tetteh for your time. As a firm, we really appreciate you taking time out of your very important schedules to be with us. I know Emmanuel said this is going to be a short presentation. I speak about 200 miles an hour, so please forgive me as I try and make sure that this is very informative for you overall. So when we look at the insurance sector overall, we see that there's been an increase in the investment portfolios overall. And most of that generally, this is across both life and non-life. And what we see is that, there's been a gradual increase in debt investments for the firms across both sectors. And that increase in government securities is something that, as companies, you should be more focused on how they're being managed. We've had various interactions, and last year, about a year and a half ago, we did have a symposium with one of our partner companies, Sampson Capital, who we've done quite a bit of advisory work on the equity side. And we'll be doing the next one next month, which will go into more detail about the equity raising options you have as a group, which we think should help meet the capital requirements in a timely manner. So as I mentioned, we've seen bond investments grow over time, and predominantly quite a few of those investments are dominated in government securities. We see some properties, and we see some term deposits. And as the challenges of the financial cleanup and the COVID have shown, markets can change very rapidly. So as a team, what we try and do is spend time understanding the various investment portfolios. And we as a company have built that expertise over time. And we'll go through a very short presentation that takes you through essentially how we've done this over time. So one of the key things we see, and as Ms. Amoah mentioned earlier on, trading volumes have increased right across the spectrum, mostly driven by the fact that, central bank had eased. And what that meant is that, there was more money available, but because of the lack of confidence in the economy in a COVID time where private sector has really struggled, most of that money remains in the banking sector. And if it remains there and there's no outlet, it essentially goes into government securities. So most of this trading has really and truly been led by the banking sector, as we will see. Now, the increase in trading has also had some effects, and it's not the only determinant of sort of interest rates and yields, but as investors have been able to enter and exit positions over time, we've seen that yields have fallen. So the blue line is where we were sort of around 2016, and you can see that rates were in the high sort of 20s, and over the sort of the last 3 years, we've moderated within a very sort of low band of between sort of 13 to around 17%. Which is counterintuitive given that debt profile has overall increased. The fact that investors can enter and exit positions with very low friction has meant that yields have traded relatively tight. Plus, obviously, some of the macroeconomic conditions that have prevailed in the market. So, who are the main players in the industry? You will see that domestic players are the largest. I think several years before, when the market started, it was mostly foreign players, and what the stock exchange has done in terms of having efficient systems, training, etc., has meant that the domestic market has grown in accordance with that, and is beginning to dominate that market. And we are seeing foreign investors playing a smaller role as time goes on, which should help our currency overall, because the fewer foreign investors we have, the less likely the currency is to experience shocks, etc. But it's quite healthy to have your domestic market pretty much dominated by local players. And as you can see, I mean, this is a chart that has quite a few donuts on there, but it's just to show that there is real diversification right across all the tenors that you have in the industry. And this is specifically on the government bond side. So if you look at 2-year bonds, 3-year bonds, 5-year bonds, 6-year bonds, it has a healthy diversification across investors, which means you have people who have different views. Long-term investors like pension funds, some short-term investments like rural banks, and some of the banks themselves, means that at any point in time, if you're invested in these securities, there's a good chance that you'll be able to exit your position or enter into a position without suffering too much in terms of pricing. That's in normal times and normal conditions. So we've seen the corporate bond market grow over time. That's in no small part to some of the work done by the stock exchange. I remember the National Bond Market Committee 1 and 2, which I was part of several years ago. And some of the ideas that had come up then are in full effect now. And we're seeing that advantage, and people in the savings and loan sector have taken advantage of that. And we're seeing people raise decent amounts of capital in the market to make sure they have great asset liability matching. And again, this is for the life companies as well, in terms of being able to better match your long-term liabilities with some long-term assets is really critical and important overall. So some of that diversification in your portfolio holdings is key, and those are things that we can help with. So as a firm, how do we help you in terms of your investment strategy? So we run several disciplines right across everything we do. We are very active in the market. We are growth buyers. We do integrate risk management into most of the things we're doing, highly research driven, and we do a lot of fundamental analysis. And I'll probably take you through that very quickly. So in terms of our outlook on how we manage portfolios and help our various investors, we do look at the yield curve, which Domingo mentioned. We look at the ability to have liquidity and trading ideas within your portfolio. How, for example, you can match better match your assets and your liabilities, how you can liquidate a portfolio very quickly, etc. Those are things that we help you with regards to your tactical asset allocation within your portfolio. Risk management, as I said, is key for us, and especially for our clients, which involve some institutions like yours. We recognize risk very quickly, we rationalize it, and as a team, we are always on top of how we identify these things and deal with them. In terms of our portfolio construction, it's very systematic. We do portfolio performance construction. We monitor those things. We believe we have one of the more sophisticated asset management platforms within the industry, and are therefore able to give our clients high value in terms of being able to see your portfolio, understand its economic analysis and scenario analysis. So on the economic side, what we tend to do is have a macro view and then a fundamental research view that we have sort of bottom up. So we look at data and statistics from the Bank of Ghana and other sources that we have, and try and generate a view around what we think a probability of the things may pan out, and then give some views around that for our potential clients. And that helps them in the decision making overall. One of the key things, and I think Domingo mentioned, was in terms of yield curves, etc. Now, when you have portfolios that are invested in fixed income securities, it's really important to understand how your portfolio changes over time with changes in interest rates. I think for a lot of people believe that bond prices are stable, but that can't be further from the truth. Bond prices change all the time, and it's important that even as you have your investment portfolios, you understand the movements within your portfolio. And that's something we've inbuilt into our systems, where we can tell you what happens when interest rates move up or down, when, let's say, the one part of the interest rate curve changes versus the other, and we can compute all of this and give you sort of the direct impact that it can potentially have on your portfolio, so that you can prepare for shocks that may happen and see how resilient your portfolios are. So these are some of the things that we do for some of our clients. And again, as I mentioned, a lot of our work is backed by research. We have a strong research platform. We use a lot of the newer sort of Bloomberg, Reuters, etc. Credit sites, a lot of things to be able to generate the key insights right across all portfolios. So we have a really strong research base. These are funds that we manage: the Fixed Income Alpha Plus, Christian Community Fund, the Plus Income and Plus Balance Fund. And why do I show these? Because it looks like a lot of English on that side, but when you come into the industry, we have two of the best performing mutual funds, way above most people. We punch above our weight. We may not be the biggest, but we do spend a lot of time thinking through our investment portfolios and what we do in there, and currently have two of the best performing fixed income funds on the market. I think we did that last year and have done that this year, and we hope to continue as we grow as a company. As I mentioned, even in some of our other portfolios, we far exceed our benchmarks in terms of what we do, and we hope to help you to be able to do that in your portfolios as well. As a company and as a firm, I mean, we're a group, but we do have our brokerage side, which has been very strong in the market. In no small part to some of you who are on here, the raw banks that we work with, and we have several clients that we deal with within the market itself. As I mentioned, we are a firm that is not the biggest, but again, through best price and best execution, we have found ourselves in sort of the top 20 traders in the market, and we hope to do better each time as we engage you over in terms of your strategies, etc. We hope that improves with time. Now, just to give you a sense of who we are and what we do, as I said, we manage funds in pensions, mutual, etc., which is close to around 600 million. We have about 15 portfolio mandates right across, from mutual funds to pension funds. We have key dedicated staff of about 25 people, several years of experience, and as I mentioned, we will have a special session on our views on equity, and maybe I'll share some of that with you in the next couple of slides, where we've raised quite a bit of money on the market as principals, not as the firm itself, but in terms of our experience and our background. And as I mentioned, over the last few years that we've traded close to about 11 billion Ghana cedis in bonds, in no small part, again, to the many partners who I'll show you. Again, we've done quite a few advisory mandates right across the sector, financials, manufacturing companies, etc. We've advised them on various transactions within the market. And again, the numbers look big, but as Ms. Amoah mentioned, just this year alone, about 108 billion has traded in June. So even though our number is big relative to the market, it's small, and we hope to gain some more market share with time. We have a lot of strong banking partners. We have a lot of strong fund managers that we work with, and we have a lot of institutional clients that we work with as a firm. Now, let me just talk quickly about the equity part, which we'll come to. We do recognize that there is a timetable that comes with this. And so I think in the next month, we will go through a very detailed presentation about how we think you can get to the capital requirement without, one, giving up too much in terms of equity ownership, and two, being able to meet the capital requirements. We're currently engaging with the NIC to understand some of the structures we're bringing to see whether their views are aligned with us. And once we get that go ahead in terms of the way that it's structured, we shall be able to share that with you. So thank you very much for your time, and apologies for sort of springing this up on you because you were expecting 3 presentations, but we've given you 4. Thank you very much.
Very much, Eric. Thank you for throwing more light on what we have done as Blackstar, and also what our views are on the Ghana fixed income market. And again, we'll be waiting for the session on the equity part, as you have mentioned. I have a quick question here for Mr. David, and the question has a very long preamble. But then, if I have to summarize, what the person seeks to put out there is he has seen the performance of the Ghana Stock Exchange CI, the composite index, over the period, going up and down, even though, and also which has affected the market capitalization over the period. And what he wants to know, based on this preamble, that would you say that the equity market supports a buy now and exit when? I think he wants to know what strategy to really do with this historical information about the Ghana Stock Exchange Composite Index and the performance of the markets in general.
Hi, thanks for your question. Bottom line is he's asking what kind of timing he should have when he's getting on the market. First part of the question, does the market support a buy now? The answer is yes. If you look at some of the equities that are listed, you would see some that are seriously even trading below book value. If you look at some of the market indices, yes, there are some equities that are a buy now. In terms of timing, it's very difficult for you to time the market. Nobody can say, look, going now and exit at the end of this year, at the end of next year. It depends on which equities you are buying, fundamentals of the economy, which sector, so many other factors come in play. But you just need to have a good long-term view, look at your fundamental position of the companies that you are getting into, and then you can ride the tide, but keep monitoring your portfolio once you make the purchase. Thank you.
Right, keep monitoring your portfolio, as you rightly said. And also at Blackstar, we also give, and Eric mentioned that a couple of times with our research work and the team in-house over here, we give information and various research and various market coverage on the listed stocks on the Ghana Stock Exchange. So at any point in time, you want information to help you monitor the portfolio and, go about the timing on when to buy and when to sell. You can always follow on us on that. Now, another question to the same preamble is, so given the uncertainties in return and high correlation to external shocks, the person will want to know, what would you advise issuers to position themselves, looking at a bit of the uncertainty and in relation to the external shocks that the market gets? What would you advise the issuers of security to position themselves for issuance?
I think I pointed out the liquidity that was available even within the local pool of capital. The good thing about issuing equity is that it's patient long-term capital. You don't need to provide a return immediately, especially if you haven't made a profit. So now that we've got a lot of pension funds whose attention are focused on the market, you've got a lot of people looking at the positive returns that have started on the market. It's a good time for an issuer to tap into available capital. If you tap into that capital, and I gave the example of issuers that did follow-ons in developed markets once the pandemic sets in. So once you're an issuer on the market, you tap into the capital when it's available. When there are shocks in the market and you need to do follow-ons, it's easier once you're a publicly listed equity. So that's what I'd say to issuers now. Thank you.
Right, and the final one in relation to the same preamble again. Advise investors, he wants to know, especially insurance companies who cannot afford to lose premium. So he just wants to know, I guess it's false in the same answer you give. So we'll just skip that one and go straight to someone wanted to know if you are doing an IPO with a brokerage company and you pay the firm fees and you are not successful. He wants to know what happens. I think this can also go to Ms. Abena, Amoah, if you want to add your voice to it. They want to know if you pay a brokerage firm to do an IPO and it's not successful, what happens?
Okay, do you want me to take that, or you wanted Abena to ask? But of course, that's why you need to be careful about which brokerage company you are using to raise your capital. But when it comes to fees, you know they're usually structured into advisory fees and then maybe success fees. So once you're working with a solid brokerage company, you can be sure that they will take you and do your pre-market sounding, book building, non-deal roadshows to be sure that you will be successful. But the advisory part you need to pay for, and then the success fees you pay after the company has raised the capital for you.
Right. Thank you very much. And Ms. Abena, Amoah, do you want to add anything to it?
Yeah, I was just going to say that the majority of the fee, the real crux of it, comes on the success fee, which is related to successfully raising the funds. The advisory fee, the front-end fees, goes to your lawyers, your accountants, who have to put together a document called a prospectus for your regulators, and also some financial advisory consulting fees for the broker. So that together often is a smaller part of it, but that work gets done. So a person that is raising capital will only always pay for the work that gets done. So the advisory work from the auditors, from the lawyers, from the financial advisor, that one gets done. What you won't pay for is when you don't raise capital, and that is on the success fee. Thank you.
Right. Thank you very much, Ms. Amoah. And another question goes to you, and I think this question really comes from, and a lot of the time when Blackstar Brokerage, we go out there to engage potential clients, which include insurance companies, and especially those who have not bought bonds before. The question they keep asking is, where does it settle? Where does it sit? If I buy a bond, how sure am I that you are pitching to me that I'm buying Government of Ghana securities? How sure am I that the securities I've bought is not really an investment with you, but then it's money being, in essence, lent to the government, and it sits with an independent institution that, has which means they have no exposure to Blackstar as a company if they buy through us. So they want to know, where does, when you buy a bond, where does it sit?
I think that's a very important question. And as people that manage funds, this is one of the critical areas we need to look at. There's a company called the Central Securities Depository, the CSD, which is here in the City House on the 4th floor. The Central Securities Depository holds the register of all holders of publicly issued fixed income securities. So long as the security is listed on the Ghana fixed income market, the CSD, short form for Central Securities Depository, holds the register of all holdings of all people who have invested in these fixed income securities. They hold all of this data in electronic formats. As an investor, every single investor has a unique CSD number. So when a broker buys fixed income securities for you. They will deposit it into your unique CSD number. And as an investor, you can at any time also reach out to the CSD to check on your balances. The CSD itself sends out an annual statement to all investors on the market. So the fund managers, please, the insurance companies, please make sure you are receiving this, but also know that these instruments are not held at your broker per se, or even with your bank, but these are held directly in your name with your accounts at the CSD. The CSD invests in a lot of systems to protect this database and ensure the integrity of this. And the same thing goes for trading in shares on the stock market. Every investor that wants to trade in equities on the market has to open a CSD account. And it's very important that as your account details change, your address changes, etc., you are updating this information with the CSD. Thank you.
Ms. Amoah. Another question here for Mr. Tetteh. So I think someone wants to know your opinion on the new capital requirement for insurance companies.
Well, I think that people and the markets have been clamoring for this capital insurance for a while. In other markets, you'd have stronger insurance companies owning banks and other financial institutions, but in Ghana, it's the other way around. I think we need stronger insurance companies to be able to underwrite some of the risk within the economy. So I'm all for the new capital requirements. I'm sure further down the line, after this is done, we can get into some more risk-based insurance capital, but that would be, subject for discussion later. Thank you.
Thank you very much, Mr. Tetteh. So I will just give about 5 minutes to the audience. If any of them wants to ask any question directly, maybe they don't want to type, they can raise their hand and we will let them through. After 5 minutes, we would ask for closing comment from our speakers. Then would ask Nanaji will take over. Then we'll have the closing remarks from Mr. Afedzie. Yeah, we'll have a closing remark from Mr. Afedzie. So we'll just give 5 minutes to the audience if they have any questions or they want to ask questions directly.
Hi, Emmanuel, it's Eric. I think there's one question on the platform about if you're purchasing both equities and bonds, does it happen in with the same CSD ID, or was that answered?
Yeah, so that question just got to me, right? So I'll leave that to Ms. Amoah to answer.
Eric, I thought you could take that up.
Yeah, sure.
Sure.
I'll take that up. I mean, I'm one of the boots on the ground when it comes to purchasing of securities. So yeah, of course. So it is the same CSD account, and it's I should say in a very layman language, say a general account that holds all securities that you purchase from the exchange, both fixed income and equities, and any securities that will be listed on the exchange can be held on that. So you don't need a separate CSD account for any given asset or any given security on the exchange. Just one CSD account can hold all forms of assets.
And we believe this is one of the key strong selling points of trading and investing on the Ghana Stock Exchange. The ability to have this, your assets held exclusively for you. You know where they are. You can check on a third party that can assure you that you hold these assets. The CSD is a partnership between the Bank of Ghana and the Ghana Stock Exchange. Ghana Stock Exchange owns 30% of the shares in the CSD, and then Bank of Ghana owns 70% of it. It's a very unique, a very solid company that ensures that the ownership titles to these assets are held very securely and in a transparent and a secure manner for all investors. And this is why we keep encouraging regulated institutions like you to channel all your investments through this exchange.
Thank you very much. So we'll just jump on to the closing comments. We'll start from Mr. Domingo. Yeah, hi, Mr. Domingo, can you hear me? Right, so we'll get to David then, and we'll try and reach Mr. Domingo behind the scenes. David, can you give us the closing comments from your side?
Okay, yes, I'd like to say thank you to Blackstar, the organizers, for this opportunity. It's our responsibility as players in the markets to deepen Ghana's capital markets. We are happy that we have potential issuers and investors at the same time on this call. I think that if we get more local companies, including insurance companies, to issue securities, to raise your capital on this market, it helps to deepen our market.
So
on the other hand,
who is
if
on,
you
like,
are,
their faces, just in case.
on the other hand, I think, moderator, your mic is on. On the other hand, if we get you to invest here, we take away external currency pressures, those taking out dividends, those taking out capital gains, we eliminate that, so there's less pressure on our currency. I think that we are working to get our market to deliver the long-term risk-adjusted returns we want, to keep our insurance company strong, to keep our pensioners happy when they go on retirement, and to give us all a return on our CD, when we want to. I think more of these are required, and so we'd look forward to further interactions amongst ourselves in the market. So thank you very much, and have a good day.
Sure, thank you very much. We'll move on to Ms. Amoah.
Thank you very much. Again, congratulations to the Blackstar Group. Thank you for this important discussions. To my fellow panelists as well, it's been great learning from all of you. But importantly, to our partners in the insurance sector, the life business, the non-life business, there's so much we can do together. You have assets to mobilize. So for us, the new higher minimum capital requirements are critical for you guys to deploy in a way that increases the insurance penetration in Ghana. Because as you get more premiums, we will see more activity of you looking for investment opportunities, especially on the Ghana Stock Exchange's fixed income market and on the equity side. It is this capital that you mobilize that we present a market, a regulated market that provides liquidity for investors like you to play in. So we're happy to start this discussion, and we look forward to see what you're doing in the fixed income market, where you are now a significant investor, to also translate onto the equity side. Many of us are afraid of risk, and it's very funny when I hear insurance people shy away from risk. The whole point of risk is to understand it, is to manage it, is to get the best return out of that risk. No one understands risks more than you. So please do not please come back into our equities market. Let's see your portfolios grow in that sector, because everything we know from the Ghana Stock Exchange 31-year history is that it is a market that has returned a higher than other asset classes return over the 31 years history, presenting good returns for investors that have a long term. Thank you again for this opportunity.
Now, so can we have your closing comments, please?
Thanks. Apologies, I had issues unmuting a bit earlier. But thanks to the Blackstar Group again for organizing and for inviting me. To my fellow panelists, it was great listening to your respective presentations, and it definitely gives me at least a new lens to look at the local Ghanaian market. And to everyone else on the call, we look forward to working with all of you to further grow the financial markets in the Ghanaian market for the betterment of the economy and the country as well.
Thank you very much for your time as well. So I would like to acknowledge that we were joined by Madam Marian Jani, who is Executive Secretary of the Ghana Securities Industry Association. Thank you for your time for joining. I would hand over to Nana Agyei.
Thank you very much, Emmanuel, and thank you very much, Emmanuel, and we all too soon we've come to the end of this interesting 3-day journey of idea sharing, and also thinking of the way we can do our things so we become resilient as we are in the transitionary phase of the challenges that we are. I will just ask Mr. Ekow, Afedzie, the MD of the Ghana Stock Exchange, to give the closing remarks for this event. Then I will come back for us to close it off.
Thank you, Nana Agyei. I hope you can hear me clearly. And
yes,
also,
sir, we can.
Okay, let me first of all say a big thank you to Black Star Brokerage for organizing the 3-day series of webinars. I believe that the objectives have been achieved. The topic has been very interesting. Reliability in times of uncertainty, making investment decisions while transitioning from a pandemic and financial sector reforms. Emmanuel, you coordinated this in so well. And Nana Agyei, if you hear that Emmanuel has left you, then he has come to join me. To the panelists, I think the presentations were very educative from Abena, Amoah, from David, and from Domingo, and finally Recapia, ending up by trying to promote Black Star and what you do, and also showing that it's very much alive still in the market. But on the whole, the panelists did a very good job making the participants understand the various aspects of the markets right throughout the 3-day period, from equities to the bonds and to raising capital, and also the target groups, I believe also were well selected, and therefore we hope to see some good results as we move on. The questions were very probing. There was this one long one with a long preamble where there were a series of questions. Maybe you should mention the name of the person, but those were very good questions. And I think we had very good answers from the panelists, David, Abena, and Domingo also on this. And then I also say that GSC as a market trying to provide a platform for investing and financing is prepared to partner brokerage firms such as Black Star Brokerage and others to champion this whole course of education, financial education, targeted at potential investors and also issuers. Together with you, I think we can develop this market. And feel free, you can still contact us as Black Star Brokerage firm, and we can do a lot more of these webinars to continue to educate potential investors and issuers. To the participants, let me say a big thank you for participating. I think we had very good participation throughout the 3-day period. Today, I saw, I think, about 50 or more participants, which is very good, coming from only the insurance sector today. Let me end by saying a big thank you to all the participants, panelists, Agyei, Emmanuel, Eric, for such a wonderful series of webinars that you've organized. And I say kudos to you, and we hope to partner you to do another one before end of the year. Thank you very much.
Thank you very much, Mr. Afedzie, and we are Black Star grateful to everybody who played a role in making this a success. We deem it a success for the market, and we deem it a success for the future. So everybody, participants, speakers, and to our two key guests of honor, Mr. Afedzie and Sampson, we are so grateful. The key speakers for today, Domingo, for taking time off your peak trading hours. Mates, we are very grateful and we owe you one. Mr. Tetteh, taking time off your busy schedule out of town. We are grateful. Mr. Abena, we'll keep coming back to you for more. Like I always say, you are a mom. So if it's about that, there will be more burden coming on. And everybody, our friends from the insurance fraternity. And also to Marian and the team at GSIA, you've been so supportive. We are grateful to you all. And also to the team back home here. Guys, I'm proud of you. Like I always say, Black Star has the best talent in town. And we are the best. We are taking over. We are the David of the market, and we will keep conquering. So guys, well done. And to the market and everybody, like Mr. Afedzie said, we see this as another way of promoting the market and also educating the entire investing population. So we'll be doing more of this, and we'll be coordinating and partnering with every partner or everybody that comes in. So at the end of it all, I think the greatest of the gratitude goes to the Almighty God. We thank you for being part of us all throughout these 3 days, and may God bless us all. Thank you.
Thank you very much. Thank you all.
Thank you all and all the partners and the panelists in doing this.
Thank you, Mr. Afedzie. Thank you,
Eric,
Ms. Amoah.
I need to see you physically.
Yes, sir. Thank you, Domingo.
Everyone.
Domingo, nice
Okay.
meeting you. Bye-bye.
Okay.
Cheers.
Bye. Yeah.
Bye.